It's time now for today's strategy session. Analysts across Wall Street are turning bullish on U.S. stocks. Multiple strategists boosting their year-end 2025 targets on the S&P 500 after stocks recovered from their tariff-induced sell-off. Joining us now, we've got one of the strategists boosting his target, Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist, and good friend of the show. Keith, good to see you here. Just take us into the thesis behind why you're now raising your target as well.
Yeah, well, great to be with you all. Maybe I'll take a step back for some context. Back in February, we were around all-time highs. We downgraded equities. And then towards the lows, we would tell our clients to rebalance, that you should start thinking about upside risk. On the initial rebound, when we had the rebound, we actually modestly took some off the table. In hindsight, somewhat prematurely. But at that time, our work was suggesting that recession risk was still relatively high. After that, China kind of walked back. So now, as we kind of reset and say, okay, where are we at now? In the weight of the evidence in our work suggests at least more of a neutral posture overall. And as we look at things, one, the rebound off of this low is actually a positive sign when you look off 6 months later. Instead of recession, being say 50%, I think our base case is more of a muddle through. And when something that's changed since February when we first downgraded stocks was earnings. Forward earning estimates for the S&P back in February were starting to move down. That's part of the reason why we downgraded stocks. Now they have inflected higher. A lot of that is being driven by tech and communications, and that's the final point. We had all this tariff uncertainty, right? The big T was tariffs. I think what the market has found over the last few months is the other T, technology and AI, which has been the dominant theme of this bull market, is back in the forefront.
Yeah, Keith, really excited to get your thoughts on the tech sector specifically, which, as you mentioned, you did upgrade as part of this. To what degree do we continue to learn the lesson from investors that you can rest on your laurels of the Mag 7 stocks, those big tech stocks, regardless of the broader market activity? And how bullish does that make you?
Sure. Well, the first thing I will say, we've been overweight communication services, which is kind of also an AI play all year long. We added to tech. And I think what's also important with tech, I know a lot of times we're looking at how much we've moved from the lows for the market and tech. But if you look at the S&P technology sector since last July, we're flat. And you spoke about NVIDIA earlier. That's also only up modestly since last July as well. So if you look at the big picture for the overall market, the S&P, we're flat for 7 months. For the technology sector, flat for almost a year. So I think as we test these kind of technical levels, and I think eventually we will break above that, there's probably some pain trade. That said, I just want to be clear too. I mean, we are starting with higher valuations for the overall market. So I think there could be a squeeze higher, but I don't know that we're off to the races. I certainly expect that there'll be some bumps along the way, especially in the summer where we see some illiquidity along the way. But I think in general, the underlying trend is still positive, and we want to stick with that underlying trend.
Okay, you started to answer my question, which was around valuation. So I'll tap more into that illiquidity. Does that mean low volume during the summer means more volatility in this interim period of time?
Well, I think what can happen is, well, I'm hoping for the summer doldrums, right? After what we've seen in the first half, like some boring trade would be actually probably good. But I think what can happen is if you get some unexpected headlines, a lot of people are on vacation, there's less liquidity, that I think you can see moves exacerbated as well. And there's an old saying, sell in May and go away, but that's actually incorrect. What happens really, the market tends to do well until July, and then that's when you start to see more seasonal weakness as you get into August and September. So I think that's something to be kind of on lookout for. And again, for the economy, we're expecting more of a muddle through. So this isn't to our view like, hey, this is time to be on all offense. But again, I think for investors and even people watching the show today, I think we'd be more aligned with long-term target, equity allocations. Again, not overly, on offense or defense, but the underlying trend, again, I think we have to respect it.
Right, don't fight the tape, it sounds like, is what you're saying, Keith. But I wonder to what extent you feel that investors are somewhat post-tariff and instead focused on the moves of the Federal Reserve, especially given that we are seeing such a strong market reaction to that cooler than expected inflation print this morning. Does today's market action show that the market is moving from being Trump-driven to Fed-driven?
I would almost say neither. I mean, they're both important, but I think the way I think about it is for some period of time, tariffs were the only thing that mattered. And I think we're finding out today a lot of other factors matter. So tariffs still matter, just not the same degree. The Fed still matters, but not the same degree. And I think the thing with the Fed right now, the reason why I say it matters, but it's, even if you look at the Fed funds futures or what the market is pricing in, the first rate cut is September. So think about where we are today. We're still in June. there's a lot of time between now and September where the Fed really comes back into play in a meaningful way. I think this is the step in the right direction, showing CPI coming down. I think there's still some lingering questions. Are we going to see some changes in the inflation data as some of the tariff impact comes in? I think that's an open question as well. So in the interim, I do think, I do think the economic data matters a lot, meaning there was a lot of concern about recession earlier on. Are we going to see some air pockets over the next couple months? Is going to still show some resiliency. So like things like the weekly jobless claims are going to be important. The employment picture is going to be important. The inflation trends and the Fed. So again, I think all these things matter, but I don't think it's as just specific. Like this is the main thing the market is now focusing on. And again, going back broader picture, back to the conversation, tech matters and what happens on the technical side as well.
Keith, just briefly while we have you here, it seems that a lot of firms and institutions are trying to measure what the base level of effective tariffs end the year near, and what that also looks like for Chinese goods as well within that broader picture. 15% is what one firm that I cited earlier in the show is tracking towards, and then the level of Chinese goods higher at 30 to 40%, their estimation. How are you at Truist modeling that?
Yeah, I don't listen. I think this isn't precise. There's a lot of moving parts. There's the sector tariffs on top of the universal tariffs. So I think the baseline for a lot of countries will be 10% higher on China, some sector tariffs on top of that. And again, these negotiations, as Greg Valliere just talked about earlier, who is going to take time. I mean, this doesn't happen overnight. But I think from the market's perspective, if that is the baseline, and the market can likely adjust, they understand it. If it becomes where we have some tougher negotiations, and you may have some of that causes that volatility in the summer later on, I think that will scare the market. But at this point right now, where they are today, I think the market is comfortable that companies can adjust. But it's still an open question where we end up, say a year from now or 2 years from now, because we're really just beginning this longer term process.
Keith, amazing to chat with you. Thank you so much for making the time this morning.
Great to be with you guys. Thank you.